I see a few participants. Looks like we've got about 2 minutes on the docket before we start. Dion, if you're listening already, give me just a minute. I'm going to get some hot tea. My voice was getting strained earlier. I'll be right
Sounds
back.
good. Yeah, sounds good.
We got some hot tea, Dion, and we got another dozen folks in the room. I'm feeling good about the November webinar. We got some exciting things with Cityfunds, new funds launching, new acquisitions. Give some folks a few more minutes, hop in here. We got incentives to talk about. I'm going to open up the Q&A section over here on one page, the chat on another page, just in case we have anybody who asks questions throughout the process here. We're usually pretty good about answering all of the questions in the the body of the presentation, but sometimes we get to the end of the presentation, there's a few extra questions. We try to get them all addressed though. I see a few familiar names on the list. David, always good to see you in the room. James as well. And some new folks. Tracy, Rick, welcome. Jim. Corinne, Albert. Welcome to the Cityfunds presentation. We're about to get started. And Deanna, hit the button. Leon, it's 6:05. Should we get this show on the road?
Oh, let's go ahead and get it going here. Thank you. All right. Sundance, can you see the deck there?
Yep, we see it. Did you open up chat for everybody?
Yeah, chat. How
No
can I
questions.
tell yeah, so two host panelist, let's see, everyone.
There we go.
Test.
It looks open to me. But I think we're panelists, so if there's anybody in the audience, you want to put a tester in there? I think last time, for whatever reason, our settings had it like defaulted to not allow folks to chat, and everybody had to ask a question, which was okay. We figured it out, and there were some good questions, but sometimes chat's faster.
I see the hand raise feature works there.
David says it says disabled.
Disabled.
If we can't figure it out, it's not the end of the world. We can just have them go through the question and answer section like David did.
Let's see. So everyone.
So true story. My daughter has a shirt that says "I own Dallas," and it was my father's birthday yesterday. So his granddaughter there shows up and she's wearing the "I own Dallas" shirt, and he starts asking questions. And he knows about Cityfunds already, but he was intrigued to like buy the shirt enough to ask the question, "What's going on? How do you own Dallas?" And I love that conversation, man. I hope everybody on the chat here who's tuning in either has a T-shirt already or will invest and ask us for one. We're pretty liberal with the shirts because it's fun to talk about.
All right, so that should do the trick there. I don't know if someone wants to get a try again, but I think I found the button. So
All right,
full
good
calls
deal.
later.
Gabriel, good day to you as well. Appreciate Gabriel's first time here. We appreciate you stopping in. I mean, every month we do these, and there is always some additional like new information. There's updates, what acquisitions, and there's new activities that go on in Cityfunds. We appreciate that. But there's always a lot of like first-time investors, or maybe even some folks who haven't invested yet that just want to figure out, okay, what's this all about? So we try and gear some information for the veterans, the City Funder veterans, and the folks who are just kind of dipping their toe in the water here.
hmm Yeah.
All right.
All right, we can go ahead and get started. So this is kind of our high level agenda. Like Sundance said, we can kind of go off rail a little bit and talk about, depending on what questions come to the chat and stuff, some other topics. But in general, we definitely want to hit on the core aspects, which is just the opportunity that our fund is investing into, and that the problem that kind of came from that opportunity, we saw the opportunity through, sorry. And then, our product, our solution that we have to solve that problem, which is Cityfunds. We'll give you an intro on that. And then the underlying asset, which our firm invests into, which is home equity investments. And then we'll go into a little bit of our recent success. That's a time where we can go over some quick updates, some stuff that has happened. I know I sent out an email recently talking about the news with Benzinga, and then lastly we can go into some questions there. Let's see. So to start off, quick intro again. My name is Dion Robertson. I manage investor relations for Cityfunds by Nada. Nada Finance is the parent company, full service real estate brokerage, and Cityfunds is the investment arm of Nada Finance. And I am a licensed investment broker, investment professional, Series 7, 79, 63, some others. My background's investment banking. So I worked over at Citigroup on the technology investment banking team. Before that, I worked business strategy and a little bit of strategic finance for Microsoft as well. So began in tech over in the Pacific Northwest, and being over here in Texas. I spent some time in San Francisco doing IB, and now over here in the Dallas area is where we're based. Sundance, you want to give a quick intro?
Yeah, absolutely. First name is Sundance, last name is Brennan. People always ask, yes, that is my given name, Sundance, like the Sundance Kid. My official title here is head of revenue, but just like, everybody, Dion included, we all do a lot of different things. If it makes money, though, generally speaking, I'm involved in trying to make sure, hey, are we making money the right way? Is it responsible? And in addition to the mortgage licensing and the originations platform, I also joined Dion and some of the investor relations activities. I hold a Series 7, 65, and 63. Generally speaking, when we do these things, I try to give one like just interesting facts. So if you've watched like 3 or 4 months in a row, like you just slowly but surely get these like unusual facts about Sundance. Here's another one. In 1997, I bought my first house, and the down payment for that house was actually made on returns from my very first stock investment that I made when I was like 19 years old, and I forgot about it. Like my parents like helped me set it up, and it was at the time it was like a penny stock kind of a thing, and I forgot about it for like darn near a decade, and then came back to it, and I was like, "Ooh, where did all this money come from?" And I didn't blow it at Vegas. I went and bought a house. So the down payment for my house came from my very first initial like stock market investments when I was still a teenager.
Nice. I did not know that. That's actually really, really interesting, really cool. And it shows that, well, I guess you forgot it. So I was going to say you were responsible in terms of
Nope,
saving,
nope.
investing. But
Probably if I had access to it, I probably would have pulled it out, but I completely forgot about it and then revisited it, 9 years later.
what stock were you invested into?
It's a company called Vaso Medical. This is not
So,
advice, but Vaso Medical was the company, and they created like cuffs. And I like completely like I didn't know what I was doing at 19. I did some diligence, some research, and my family challenged me to learn more about fiscal responsibility. I don't know if you've ever read Rich Dad Poor Dad, but my
mhm.
father read it, and he was a little tardy, but he was like, let me try and like teach my son about financial advice and what to invest in. And we went through this practice and invested real money in a company called Vaso Medical that paid off years later. He
Wow.
he
Well,
reminded me of that yesterday too at his birthday.
for those of you on the call, if you want to search Vasco Medical, we can see what the stock price is as now, and then see if Sundays can circle back and let us know what he sold at, and we can see
Yeah,
how
yeah,
that played out there.
yeah.
Well, great. Let's get into it. So, right there on the screen, you see 20 trillion in home equity is trapped for homeowners. If you follow me on LinkedIn, I try to hit on this quite a bit. Roughly, the average American roughly has around $250,000 in home equity. In today's market, virtually little to no ways of accessing that equity. And I just posted today about what's going on in commercial real estate, and that is pretty much very similar to what we deal with or what we solve here on the home share side. So that's the providing financing solution for homeowners. Essentially, there's a lot of homeowners that they want liquidity, they want that equity in their home to be in the form of cash, and traditionally the way they get that is through refinancing, doing a cash out refinance, a HELOC, some sort of debt vehicle that alters their mortgage, increasing their debt and cost of living. And that's really tough to do in today's economy with 8% interest rates. So we provide a equity solution, which is essentially an interest-free loan in which we invest, give them that liquidity in exchange for an equity stake in their home's future appreciation, their home's equity. So, in doing so, we profit off of their home's future appreciation. And we can go way more in depth in that in a bit, but I want to give you guys a high level overview right away. And that's beneficial for us, the investment fund, and very beneficial for you as the investors. We'll go into why that is in our strategy of how we acquire those assets. But it really is a win-win for the homeowner too. We really are helping homeowners reduce their debt and provide them with liquidity in a market where today 8% interest rates, you might really need $40,000 that's trapped in your equity to home improvement or pay off debt. I know a lot of you guys probably want to pay off debt in this market. Different stuff like that where it's a really great mission we're doing, and there's a lot of great feedback from the homeowners we're helping. So as you go through this presentation and you think, hey, this is a great way to invest into real estate and get true equity exposure into some of the most in-demand markets in the US, being Austin, Miami, Dallas, Tampa, now Denver. and in Phoenix, those opportunities we'll talk about. You also think, hey, I'm really actually helping homeowners too. And a lot of other situations when it comes to investing, can sometimes be sort of a lose situation for the asset you're investing in. So that's one really good thing about Cityfunds.
Well said.
So another problem that I wanted to hit on is not just the homeowner lacking liquidity, it's also Main Street investors, retail investors, um, uh, being able to have unique ways to invest into real estate outside of the traditional ways. Real estate historically is a alternative investment, and a lot of it can be speculation, a lot of it can be growth. But when it comes to alternative investments, you see kind of the same stuff, rental properties, some commercial real estate, multifamily. But generally, when you think of, the American dream, you think of single family residence, and you think of your neighborhood and what it would be like to own a home and really get that equity appreciation. But you think of the different ways you can invest directly into the equity of a single family house. There really is little to no ways as well for retail investors like you and I to say, hey, I want to throw $15,000 into, my neighbor's property and provide them with liquidity and profit share on the back end with them. That'd be really cool. But how do you do that? You can't really go on Fidelity or Charles Schwab and just, invest directly into equity of single family. You can do it through typically like a REIT. But as you guys all know, I know a lot of you guys are in REITs. I'm in REITs as well. REITs really aren't set up for growth. You buy into a REIT at 10, and over the next 2 years, you get some nice dividends with some income, but you look at it and the stock's at 2 or something like that. So there's need for more solutions for mainstream investors to get into real estate. We can end the call right there. That's all we're here to do is offer another solution for accessibility into real estate through a unique way that is poised for growth. We'll go next. And with that said, we have these solutions, this full service brokerage that Nada has built, the system. We have on the left side, we have home shares, which is what we talked about in the beginning, providing that liquidity to homeowners in exchange for an equity stake in their home. That's the agreement we're doing. It's called a home equity sharing agreement, also known as a home equity investment, HEI. If you guys read, Forbes, NerdWallet, Chartered Alternative Investments Association, HEIs are becoming very, very mainstream. It's the talk of the street, if you will. And it's a very unique opportunity through our fund, as we're one of the only index-like funds that provides access to HEIs in diversified funds like the Austin City Fund, Miami City Fund. So it's truly the way to get into this unique asset as it gets on the rise. We're going to talk about more about what's going on in the media with HEIs. Cityfunds is the diversified pool of HEIs. So we have 6 markets right now. Each high level city funds, we have a city fund for every single market. Austin City Fund, Miami City Fund. What's in those city funds? Those are diversified pools of home equity investments. So diversified pools of home shares. You hear that a couple times and it starts to make sense. Just think the left side home shares is bundled into the right side city funds, and that's what you're investing into. Very, very unique, very, very cool. So going back into city funds, through city funds, you can now own home equity in a top city. The reason why you typically would buy a diversified fund of really anything is accessibility and less risk. If you go and do a HEI, which, maybe you heard this already, you're like, oh, I want to invest into a portion of my neighbor's home. That'd be really great. That's just one home. Our portfolio has, I think, just around, 80 to 90 assets in it. So by going, when you're kind of newer to an asset, you probably want to get a diversified fund that you can kind of ease your way into, that you have more access to and less risk going into it. So that's the benefit of this, of how this works in a market where you're able to kind of get that diversification. For instance, Austin, very, very high demand market. really all these markets are super high demand. I'll just pick on Austin for a second. Starting off doing your first HEI out there, just getting that set up would probably be very difficult. And to be able to get direct equity in a pool of top properties around the Austin area, that diversification is why people decide to kind of get in our fund, the convenience, and we can talk about how convenient and what people are saying about our funds. High level, creating an entirely new way to own home equity in these top cities. Sundance, I'll go ahead and pass it to you. I talk about Cityfunds as these home equity sharing agreements, these home shares bundled in one. Sundance VP revenue, he's right on the ground, right front facing, underwriting these home equity investments. He's the expert. He kind of knows the strategy and the benefits to these homeowners. Sundance, can you give a rundown on just kind of the purpose of a home equity investment for us? Why they're exclusive, and talk about stuff like what they're secured by.
Absolutely. One of the most there's a lot to love about home equity investments, city funds in general, but the lack of competition just astounds me. That there's all of this equity, $20 trillion you showed on that first slide, and I actually think it's closer to 30 trillion. There was a report that came out earlier today from, or not early, or earlier this week from Housing Wire. It says it's closer to $30 trillion, and there's nobody really competing to help out to liquidate that equity. That $30 trillion is just sitting there on the books. Meanwhile, credit card debt is piling up, and it just astounds me. The demand is really high, but when their demand is high, we can be choosy on the acquisitions. And a lot of the questions come up from investors: how do we acquire these properties? How do we choose, which homes to invest in? So number one, the purpose is it's an alternative financing option for homeowners versus taking out a loan. Dion articulated that earlier, and he even gave some nice use cases, like let's say like home improvement or debt consolidation. But we also see alternative use cases too. Somebody just came to me today and said, "Hey, I've got a homeowner who actually owns 2 or 3 different properties, and they need a little bit of fixer upper kind of like love in order to put them on the market and sell them." So this particular person has a portfolio, I think, of like 30 homes, and 3 of them need to go on the market, and said, "Hey, can we get 3 home shares? I need to go in and put like $30,000 into each one of them so that I can get top dollar price when we sell the property." Well, yeah, that's a really good investment for on our part. Like, let's give you the $20,000, $30,000 so that the home value goes up, and we know it's going to liquidate in the very near future. And that's just one really good example of how people use home shares. It is exclusive. City funds, you can read this, are the only fund that allows investors to invest alongside homeowners. So like a home equity sharing agreement. So we share in that appreciation together. And sometimes that's, we get to realize those gains in a year. Sometimes it's 5 years. Sometimes it could be 10 years. But we have, the longer we hold it, the more appreciation presumably we will see. Now, because these are primary occupancy properties, we are aligned a lot of cases for those like longer term properties. If somebody's going to hold on to it 10 years, they're probably going to take care of that property. Like it's their home. And really, like, if we see equity sharing, they see equity sharing. A home equity agreement means, maybe it's an 80-20 split. Every new dollar that comes into appreciation for that property, maybe we get 20 cents and they get 80 cents, we being the investors for city funds. And these are in the money. So when a client contacts us, we will discount the property valuation, meaning we'll look at the true market valuation, but we will allocate some discount based on volatility. So it's easy to think about this way. Like, Deanna, you own your house and you say, "Hey, Sundance, I need $40,000 like this, and I don't want to take out a new equity line. Maybe I've got tax returns that are a little complicated, or I need it quickly, or whatever the scenario is." Okay, that's great. We'll essentially take $45,000 worth of equity immediately in exchange for the $40,000 directly. So these are interest free, but there is an exchange, and there are some gains there that's built in instantaneously. We have that extra equity built in. That's what we mean by in the money on day one. And then we secure these with a lien. It's in Texas, it's deed of trust, depending a little bit on what state you're in, what the security instrument is called, but it is a second lien And that term HELOC, if you're not familiar with it, home equity line of credit, but it might as well be a second mortgage or a home equity loan. And maybe 10% of our files, we're actually in first lien position. So it is a lien on title. We record with the title company. So hopefully that gives you a little bit of insight in, what the process is, how we go about securing that home share, the investor's interest in the property.
Thank you. Thank you. Oh, all right. We can move on to a little bit of our traction here. Sundance, I don't want to butcher the numbers here. Do you have an idea of where we are in terms of AUM as
I,
of maybe this month?
I asked, actually, I think yesterday in our team huddle if we had crossed over 7 million, and it was very, very close. So as of this moment, we're probably, we may have crossed over, but it's very near $7 million in AUM. It's definitely over 11,000 total retail investors, and I know that we have done 86 properties as of this recording right now, and we've originated over 100 of these. So we're climbing up for sure.
Hmm. Yeah, yeah. And then in terms of properties funded, did you want to hit on just kind of the plans that where we stand from that 70 plus and kind of what's next?
Yeah, sure. I can actually tie that into a question that we've got here about rising interest rates and how that impacts demand for the product and appreciation. Like, what does that do in general if appreciation stalls in a market like this? And it's really interesting. So yes, there's high demand. Like we are adding 15 to 20 of these deals on a monthly basis as far as acquisitions go. We get regular emails that get sent out and tell you, okay, we got 3 more acquisitions, I think, in an email that just went out this week. So as we're closing these, we're adding in the AUM and building that profile up. Now, demand for these is very, very high. As interest rates rise, people are less likely to take out a new first mortgage. And so the demand for a 0 monthly payment second lien is through the roof because there's no monthly payment, no interest rates. And for the short term, we might see lower appreciation levels. We're okay with that because we've discounted the property 10 to 15% upfront. So day one, we've already got, 10% gains really built into the product. Now, we don't have crystal balls. We don't know exactly what's going to happen, but historically over the last 50 years, real estate has gone up. There have been some slowdowns, there have been a little, a little bit of a roller coaster here and there. But in the over the long haul, real estate has consistently been on the rise. And we believe that that is likely to continue. Otherwise, why would anybody keep investing in real estate? So our goal is obviously to mitigate, the short term while demand is high. Like let's go ahead and acquire as much as we can. And when the real estate market picks up again, then it's time to refinance. And when interest rates fall, traditionally when interest rates fall, home prices start to go up again. So even if home prices, stall out a little bit over there's high interest rates, that's actually good for us, Dion. Like we look at a 7-year cycle of interest rates and markets. We're in the part of the cycle now where it's acquisition time. We want to gobble up market share as much as possible. We want to buy the properties now because when interest rates fall, home prices rise. So we run a full real estate brokerage firm, mortgage operation as well. So when it comes time to exit these, we will proactively reach out to clients and say, let's refinance you. We can pay off the home shares, investors see gains, and then we can redeploy those funds into people that want to put in accessory dwelling units or solar, people that want to actually appreciate their home value through the transaction. And we do a fair amount of that now. So somebody else asked, how does the overall market, impact you? Well, you'd have to be smart about your acquisitions and your investments. So we've partnered with folks who are doing home improvements. And so by the time we're done with the transaction, not only do we have a fair share of equity, but also there's instant appreciation. For instance, a deal we did this week was for somebody who needed $75,000, maybe a little more, in order to turn his 1 unit property into a 2 unit property. Times of high inflation, economic uncertainty, he thinks, okay, well, I can get 2 rental units, but how am I going to get the cash capital to turn that into 2 rental units so that the property is worth more and I can get more rental income? Well, kudos to you. Here's the cash. We actually paid the contractor directly, so we have confirmation. Okay, the work's getting done. What's the scope of work? And then that valuation after the project is done is significantly higher than the cash that we put into the property initially. So, and we share in that appreciation. It's really, the money is made on the buy. When you have the right acquisition strategy, it all makes out.
Thank you. Thank you. All right. Okay, so uh here we have five more city funds that are slated. These are all SEC qualified that we are planning to launch by the end of this year here. Phoenix is already active. That one's exclusive for the portfolio fund. I believe right up next would be Sundance. Is Nashville? I think Denver we just launched, and then Nashville and Phoenix are active for portfolio fund. So if you're a portfolio fund member, you have first money access into both those two funds. And then Las Vegas and LA will also become available to the portfolio fund first, and then I believe at some point, maybe beginning of 2024, Vegas and LA should be available for the at the city level at the
No,
city level. So you should be able to do those through your app.
LA is available to investors through WeFunder. Don't hold my feet to the fire on that, but I'm pretty sure it's the
Mm.
LA fund that is available exclusively through our WeFunder site. So if you are a member of WeFunder, go check them out. And if somebody wants to go check it out now, let me know if I'm wrong. But I'm pretty sure that it's Los Angeles that is available exclusively there, and it's on like reservations only, like testing the waters only through the WeFunder site, so it's not actually active, but you can put your reservation in through there now.
Mhm. Yeah. So there's some exciting funds. We're already thinking about which funds we may want to do next. And I've heard some chirps about Atlanta. I think John even mentioned Seattle the other day. Um, but yeah, stay tuned. Entering the new year, midway through, Q2 2024, as we talk about which markets we'll have later on. So that'll be exciting. I do want to talk about the portfolio fund for a moment. This is our most elite fund. It's a actively managed fund with exposure to all nine markets, and it will be the first money into all the new upcoming markets will go to portfolio first. There's even some opportunistic areas like Pennsylvania that portfolio has because it's a 506c3 Regulation D SEC offering. It has the capacity to do a one-off direct home equity sharing agreement investment in really any city out there, so it can kind of casually expand outside of just the nine markets. Great fund. It's a boosted gain, so it's targeting that 20% IRR, so a bit more than the city level markets. For those of you who are looking for that increased boosted gains there, and it is a 5-year term. Redemption period starting just after 12 months. For those of you who may be looking for liquidity, just 12 there. I don't have a slide here, but we also launched a second accredited offering called the Yield Fund, and that is also a 5-year term with a 12-month redemption program. That is a fixed income strategy. So I believe the terms are 8% interest, and that will be a 5-year term, 8% annually. So that'd be broken down and paid out quarterly for those of you who are looking for that quarterly income. If you're interested in yield, if you're accredited, we have the income strategy as well as portfolio for that growth strategy. A lot of our investors are starting to pile both those together. So we have investors who are in portfolio and yield. So we have the boosted gain on the appreciation side as well as the income. And that's probably the best way to do it. And then if you do the trifecta, you kind of get all three, where you have the less diversification of the city level funds and kind of can manage those yourself. And then you have kind of the professional portfolio fund on the side, and you have the yield. So if you do qualify, I think it'd be great to kind of do the trifecta there to make the most out of it. And Sundance, was I missing anything about portfolio that would be good to highlight?
I think you nailed it.
Okay.
You see here like the pictures from everywhere. So not only is portfolio in all the cities that we have, but it's really like being in our business, we get opportunistic deals that come our way anywhere in the United States, anywhere that we are licensed. So we originate these things as with a licensed mortgage origination. So we are currently in 14 states. And if a deal comes our way from Pennsylvania, or a deal comes our way from somewhere outside of Denver and Colorado or California, wherever it is, if it makes sense, then we want to make sure that, hey, we can provide value for our portfolio investors, so they have some direct investments in those too.
Yep, we are getting really aggressive on portfolio fund here. Portfolio last updated last month on the 15th, I believe. So we need to update this slide. The share price is now 104.19. So it appreciated 4.19%. And I believe the next update is actually here. Today's the 8th. I believe the next update is either the 15th or the 20th. So be on the lookout for my emails. If you're looking to get in portfolio before then, I highly suggest you do. And otherwise, if you are interested in yield or portfolio, please reach out and we can, one, see if you qualify, and two, if you do, kind of get you going with a subscription agreement that will kind of lock you in the price, and go from there. I believe this is the last slide. So we can go ahead and get into questions. I do want to hit on just a couple updates before we do. I sent out an email yesterday. We've been invited to Benzinga's FinTech awards this year. Sundance, John, the CEO, and I will be in New York next week on the 13th to attend the ceremony. And a big honor for the team to be able to be represented as one of the top fintech investment platforms of 2023. In my email, I sent it off to you guys. It's a big thank you to the support that you guys have put in, the feedback that you guys have shared with your friends and family, and just the media out there about the investment itself and everything like that. It's going to be a great time. So I just, on this call, definitely, before we send you the news and updates next week, just wanted to take the time to say thank you guys for the support in the fund. With that said, we can open up to some questions here. I have the chat to my left, and I will open the Q&A to the right. Hey, Gabriel, yes, this is recorded. So we should be able to, get this to you guys after, for those who missed. Coming in hot here, I think Sundance has dropped an incentive. So heard it here first. 2,500 up to 10,000 earns a 3% share match, and 10,000 to 100,000 earns a 5% share match if we win on the 13th. So it's not guaranteed. We need to win the award. We'll be over in New York. We'll probably do some live stream or something on one of these apps, but that will be a good time. So be engaged, be on the lookout, be able to get that incentive if we win there. Thank you, Sundance.
Some of these questions seem like they may be more pointed towards my specialty here. Can we use equity in an investment property, or it has to be a primary home? So, Jeet, yes, we have both occupancy types. We have primary, secondary, investment homes. The vast majority of our portfolio is primary homes, but we do have a smattering of investment properties as well. Generally speaking, the investment properties or shorter term holds, meaning it's we have some fix and flips that are really short term, high gains in a short amount of time. That's why you see, like on portfolio especially, we might outperform the 20% IRR because we get to reinvest those funds right away. And you heard me mention earlier, a particular client called and said, hey, I've got 3 properties. They all need a little bit of work. And I get 3 of these home shares. And the purpose of that is so that they can fix up the property and sell it, which means our investment, we realize our gains relatively quickly. So even if it's a longer term hold, though, we do offer some investment properties. So reach out to our office, hello@nada.co, and we'll be happy to walk you through the application process and talk about that. Or if you're just looking like, hey, what's the diversification in my portfolio, roughly 10% of the property portfolio is an investment property. Oh, I see some more questions here. I'm going to keep going, Dion, until I get to one that's maybe not in my wheelhouse.
Yeah.
All right, so Chris has a question about the NAR decision, which was a big one. Like that was earth-shattering in the real estate brokerage world. So if you're not familiar, you can go Google it. NAR and Keller Williams, actually, which is another big real estate firm, they were basically sued, had a judgment against them for $1.8 billion, billion with a B. The crux of the issue was that they were colluding and forcing the sellers of homes to pay the buyer's agent a 3% fee. And, they wheeled out a lot of testimonies and really a lot of their own like damning evidence of their own training material about how they taught agents not to even show houses that didn't show the specific fee. Um, we followed the story. We were eagerly watching it. However, Nada has operated as a discount brokerage since its inception in 2018. So we never charged that fee to begin with. In fact, we railed against it. We're on public record. Like, hey, we never liked that fee. Doesn't impact our business at all. We have internal on-staff real estate agents anyway. And we offered that discount to you or our homeowners. Like if somebody is an investor or somebody is owns a home share, and you're looking for discounted real estate services, we offer a full service mortgage brokerage, real estate brokerage, and investment opportunities. So we've got the full gamut there, but we offer those discounted services over to you. So if anybody's looking for a discounted mortgage in this market, a purchase transaction, or real estate services, reach out because we do offer that just as a side benefit to anybody associated with NADA or Cityfunds. Okay, you've got a question. So to understand better, you get home equity from homeowners or mortgage lenders? I think that's the question there. And then do you invest that money in some investment and that's the profit? No, the investment is actually into the property itself. We take a second lien. So instead of you going to a lender if you're the homeowner, you would come to us. And instead of getting a loan, you get this home equity investment. The gain is realized when that particular instrument or that house sells or just pays back and buys back the equity at the higher amount, whatever it has appreciated. And remember, we bought at a significant discount. So even if the house depreciates a little bit, like we're still in the money. And somebody had asked earlier about losses. We cap like if something catastrophic came through, we cap our annual losses at 10%. So part of the reason to diversify and not just buy your neighbor's house is something might happen to one house, like like one street might get flooded, or if a tornado comes through and insurance didn't cover the proper, things happen. If you only have one property, that's a pretty heavy loss. But if you've diversified, you've limited any losses, and it's less likely to see that those negative actions take place. So that's part of the reason we really like this model with diversification. It protects and adds that layer of security, I think, to the overall investment portfolio. So we really like it when there's the portfolio grows, but it's the actual appreciation in the home when they exit that agreement or sell the property, or refinance. We facilitate that exit. One more here, I think that is, oh no, this one is yours, Dion. So I see you introduce portfolio and yield. What's the timeline for opening that up to more than accredited? Is there an IRA option? So Chris asked that question. That's you, Dion.
Yeah, two questions baked in one. I'll start with the first one. So portfolio and yield are SEC Regulation D 506c3s, which just means they are accredited only offerings due to SEC regulations, which, as you can see by the higher entry point. So that regulation wise just will not be ever open to non-accredited investors. Regulation D is subject to only accredited investors. Now, there is actually certain situations where you're allowed a certain amount of non-accredited investors. So it definitely is something that as we, the fund just opened about 4 months ago. So a portfolio fund, should I say, and it is a very exclusive fund. So it's limited to 99 investors. I think as of today, we only have around 67 spots left. So it's just been first come, first serve for that accredited pool. If there is someone who is non-accredited, who is able to, meet the minimum and is very excited about the fund, excited about the company, please reach out. I'm sure Sundance, John, and I, and the whole team would talk, and potentially we can make something happen as we talk with our brokers and our sponsors to see what we could do there. I know it has definitely been done. I believe before regulation was max 20 for non-accredited. So it just depends. Definitely, if you're interested, reach out, and we'd love to keep the conversation going to see what we could do at all for folks in that situation.
Self-directed IRAs.
Self-directed IRAs, yes, we've partnered with Alto IRA. You can just go on their site. I can send you a link if that's how you'd want to invest. It takes about 5 minutes to sign up on their site, and they do a partial IRA, so you don't have to roll over your entire IRA into a self-directed IRA. You can, if you only want to invest a certain amount, 20, 30, 50,000, whatever, you can invest just that amount within 10 minutes to Alto IRA. And then there's a special Cityfunds link where you can then find Cityfunds on their portal and invest into it. So the whole process, if you have an IRA and you want to invest in that, could take about a day, 2 at max. We can certainly get that done. And if you have a self-directed IRA in general already, then you don't need Alto IRA. We can just get your account information and get that set up within a day as well too. So we are very pro self-directed IRA, and we can very much so make that happen.
Yep. All right. Rick wants to know if we envision getting into the commercial space anytime soon. That's a good question, Rick. Like we get this fairly often, and my philosophy is you got to know your lane. Like we know residential real estate, upside, downside, inside out, any market, this market, high market, low market. You know, we are specialists in the residential real estate. We're familiar with commercial real estate, and some of us invest in commercial real estate. The cadres out there, Grant Cardone's REIT is a good one. Dion mentioned earlier, like he's invested in REITs. That was a commercial REIT. We enjoy those products. We see value in them, but it's just not what we do. We really specialize in residential real estate only, and unlocking that untapped equity position that's out there. And I think it's really important to notate, like, all those other options are good options. That's just not what we do, and we don't really want to get into that. We want to specialize in residential real estate. What are the tax implications? What changes in tax returns are needed? And there's two sides of the transaction here, right? Either you're the homeowner or you're the investor. Investors have a 1099 div. For almost all of our funds, I think maybe the portfolio might be different based on the structure, but we whenever it's necessary, if there are gains to be realized or dividends announced, we will make sure that we send out the correct tax forms for you, so you can go talk to your tax professional and figure that out. As far as the homeowner goes, we've been advised, and reminder, we are not tax professionals, but according to the best advice given to us is that the homeowner doesn't realize any taxable situation. When you take out a lien on your property, that is not taxable income because you didn't actually sell that. It's represented by a lien. If we were to remove that lien and take a tenants in common situation with you, then it would be a taxable situation. But because there is that lien, it's not taxable. And then this leads into the next question. It says, what if somebody stays in their house for 20 years? How does anybody see profit in that? Well, it's a 10-year option. It's a 10-year term. So that lien is in existence for 10 years. At the end of that lien, we have an agreement that says, hey, you agreed to sell me, that equity at a certain price, and it was discounted at a price from 10 years ago, so it's at a really sweet price now. So we can execute that. That would be a taxable event because you actually realized, if you were the homeowner, then you realize that income from selling a portion of your house. In all likelihood, though, we facilitate your exit from that. We either give you a new option for another 10 years, or we help you refinance, and we proactively manage this as a portfolio. So we'll reach out to you ahead of time, 6 months ahead of time, to the homeowner and say, hey, it's time to refinance or get a new home share. Which one of those makes sense for you? Or, as I mentioned earlier, we have a full real estate brokerage firm as well. So we'll help facilitate. If your intention is to sell the property, we'll help facilitate that for you. So nobody gets to 20 years unless they have gotten a new option agreement from us, Jim. What are the costs associated with securing a home equity investment in HEI? We call them home shares. It's about 5% of whatever that home share dollar amount is. Really, it's about $4,000. In most cases, some of it depends on the dollar amount of the home share that you receive. But based on $75,000, $80,000, something along those lines, you might see $4,000 worth of closing costs. That goes towards home inspections. It goes towards there is some origination fees. So you see a couple of points in there for origination fees, title fees, home inspections, credit reports, things like that, just like you would on any other mortgage transaction. In fact, legally, because there's a lien, this is technically called a mortgage, not to be confused with a mortgage and a note. There is no note associated with this, so no debt, no monthly payments, but there is a lien on title. Happy to go in more detail on that. It's hard to do in a limited amount of time, but suffice to say, there's quite a bit that happens on the back end to make sure that everybody's in compliance. And let's see. When it comes to the second lien, Tracy has a question. Does the homeowner are they given the opportunity to buy that lien out? And yes, absolutely. They have the full 10 years to buy that lien out at based on the new valuation of the property. So that's how we realize gains for investors. So if we invested in your house when it's worth 500 and you want to buy back that equity share when the house is worth 600,000, well, your house is appreciated 100 grand. Whatever our equity share is of that, that's the additional amount on top of the lien. So the lien always stays the same dollar amount. It's a lien for, let's say, $100,000, but then we have that share of equity up or down. As I mentioned earlier, we limit the downside, but we've got, depending on how long you've owned the property, it could have appreciated quite a bit. So yes, we will help facilitate the exit there. Gabriel's got one more question. How do we get to the 17.5%? How is that calculated? I think he's referring to the IRR. And I mean, IRR is different from like APY, but I can give you some general parameters and tell you that a home equity investment has a cap effective interest rate of about 18% if you're a primary home and 24 if you are an investment property. So I mentioned earlier we've got about 10% of our portfolio is investment properties, and some of those don't even hold for a full year. So we get to reinvest those funds over and over and over again. So we do, in fact, anticipate a fairly high IRR. Nothing, that's our target. As far as calculating that, we actually have outperformed that several quarters, but we send out updates very regularly. Dave Ong, who runs that, the share updates, has annualized some of those. And in fact, on the 15th, you'll see our newest update as far as I think two of our funds are updating on the 15th, Dion, is that right?
I believe so.
Yeah. So we're updating those on a monthly basis now, and roughly 14 or 15% of our investments have already paid off, and we've redeployed those funds. And the fund has only been active for just over a year. So the ability to redeploy in less than 12 months really helps compound those returns, especially because we have that in the money position initially. We're essentially buying equity at 10 to 15% less than the current market value. Do we do it? Did we get to all the questions, or are there a few more I didn't see yet?
I think that is
I was on a roll.
what city do you suggest to invest in for starter? I get this question every single day, and if you're doing the individual city levels, you have, I think, 4 or 5 options. We choose all of these markets specifically because they're areas with constrained supply and lots of demand. So my answer is, so non-biased. You can't go wrong with really any market. I can tell you just history of the investment of the fund. Austin seems to be the most popular for XYZ reason. Right now, I think Dallas is technically the top performing, followed by Miami. So there's different stats you can look at of the fund to maybe sway your decision, but they all are great funds, all targeting that 17.5% IRR mark. So I'll say that if that helps, Gabriel. I think another one just came in, Sundance.
How does it compare with real estate investment opportunities? What's your differentiation? Compare with other real estate RE? I think are you talking about like GPLP opportunities in all likelihood here? Is what I would suspect. And the differentiation here is probably, not a deal by deal basis or short term. City funds are open ended funds. And so once you invest in, we recommend that you hold them for at least a couple of years. Give us time to put your capital to work. And then our intentions are to announce redemption periods. The first one should be in 2024. Um, n- so there's no defined exit timeline on a city fund. And the IRR is, because there's not one property in particular, it is many, many different properties. So we anticipate 14 to 17% of those being paid off at any given time. But the liquidity events come sporadically, I guess,
Yeah.
versus defined, opportunity.
And I like this question because I wish this was a one-on-one call right now. But what I will say is we do have a pretty strong community of investors at this point, and it's only going to grow even greater. And my point of that is, for instance, the portfolio fund, we have members in the portfolio that are in a few different real estate investment opportunities. So I don't know which one you are specifically thinking about that comes to mind, but for instance, a big name in real estate arrives or Fundrise or Yield Street. We have investors who I will say they prefer us over those companies, but they are in all of them. And it is nice to be able to be in a fund with other like minded investors who are regularly investing in alternatives where you can feel comfortable sharing your insights with other investors and see what's worked for them. I had, and I can't go too much into it with just investor privacy, but once you're inside, the community, definitely feel free to, kind of research and get a better understanding of what's out there and what other people are doing. So a good question that I think a lot of investors generally have going into anything. There is no one answer for something. And when you talk about real estate investment opportunities, there's a lot of them. So it's good to kind of pinpoint which one and see what's working for other people, and then you can kind of compare and contrast.
Yeah, I think it's important to understand what your goals are and what your the current scenario is. If you're looking for monthly coupon or passive income on a monthly basis, this wouldn't be the right opportunity for you. But maybe our yield offering would be. So it really depends on what your goals are. I think our
Absolutely.
contact info is on the next slide. I think that's important because there's in all likelihood. There you go, there's probably more questions out there. If we didn't get to your question, or if you didn't want to put it in the chat for everybody to look at, then by all means, shoot us an email, sundance@nada.co, dion@nada.co. We are accessible. We, typically respond that same day, but definitely within 24 hours. You can also go to like just nada.co. There's a chat feature there. If you go in at like 2 in the morning, I might not respond right away, but if it's within business hours, you're going to get a response back, at the very least, like, within 30 minutes, maybe an hour, from that chat feature that goes back and forth there. I see you got Jim's question about Phoenix and the high tech area. That's a good topic. So Jim just mentioned that Phoenix is a high tech area where there's a lot of like activities that go on there. I actually have a strong connection to the Phoenix area. I own a property, 40th and Union Hills, up there, and I was one of the founding members of it's called Quicken Loans. Now it's called Rocket, a huge company now, but I was one of the founding members of the group that opened up their West Coast headquarters out there. And I was out Phoenix for a long time. And that's why you'll see Cityfunds on our Phoenix connection. We don't invest in cities that we don't have a connection to, that we don't have boots on the ground, that we have some familiarity to. And a place like, Nashville, I lived in Nashville as well, LA, strong mortgage connections there. You see like Vegas. So we make sure that we get real estate agents that are in Vegas because I don't have a personal connection there. We make sure we have trusted individuals that know the markets and the areas so that when we're investing, if it's on behalf of somebody else, we really want to make sure that we know the markets, the areas, and it's like a key function. Somebody asked, why don't you invest in commercial real estate? It's because we don't know commercial real estate, but what we do know is residential.
Solid. All right. Yes, thank you guys so much. Thank you, Rick. Thank you, Tracy, Jim, all of you guys hopping on here. Great session. This is recorded, so we'll go ahead and send this out by the end of the week here. And if there's any more questions, keep them rolling in. We'll be on for another second here. But the big news that I want to hit on again, stay tuned for next week. I believe the event Benzinga's FinTech Awards. It's hosted by O'Leary Ventures. So that's Kevin O'Leary's venture office. And I believe he himself will be speaking and presenting these awards. So it's a great honor to be going out to New York and being represented and all of that. So this really is. I talked to a lot of you guys on the phone, and we go back and forth. And I always mention this really is a team sport. It's a group effort. When you guys invest into Cityfunds, we go out and we use that capital to acquire these assets. So it really is all hands on deck. The more we collaborate, the more we can go out and attack in this market, which right now is a great time to go out there and be using our strategy. So there's no better time to be putting your cash to work. And the benefits, you can see the fruits of this is just having great things like Benzinga notice us. We'll all kind of share in this celebration next week.
Thanks, everyone.
Thank you. I believe that is all the questions. So we'll go ahead and wrap it up. But we'll send this out, and thank you guys again for joining, and we will see you guys next time, okay? All right.
Happy investing.